Opendoor stock closed Tuesday's session lower, falling 41 cents or just over 5.5% to end the day at $7 even. It was a choppy, uneasy session, one that didn't see any major market shocks, yet still ended with open under pressure. What's important is that this move took the stock below the $7 support line that had held for several sessions. That support has been a kind of psychological anchor for investors, so watching it give way, even briefly, naturally raises questions. Is this a warning sign, or is it just positioning ahead of this week's big catalyst, the housing data due Thursday? Across the broader market, conditions were soft but not dramatic. Major indexes drifted, interest rate chatter was quiet, and traders seemed content to wait for the next set of data before making any major moves. For Opendoor, though, the silence can sometimes speak louder than words. When there's no new company update, no surprise announcement, no tweet from leadership, investors start looking ahead to what's coming next. And right now, that next is clearly the housing report. The housing data expected this Thursday will be the first major real estate pulse check since August's surprisingly strong numbers. Last month, we saw sales beat expectations and affordability improve slightly on lower mortgage rates. That fueled hope that maybe, just maybe, the housing market had found its footing again. But this week's report will tell us whether that optimism was an outlier or part of a more durable trend. Given how closely Opendoor's business is tied to transaction volume, traders are starting to hedge against the possibility that the data might not be as rosy this time around. That, more than anything else, likely explains Tuesday's sell-off. It wasn't panic, it was positioning. A market taking some chips off the table before a potentially market-moving report. The stock spent most of the session oscillating near even before sellers took control late in the afternoon, pushing it below 7. Volume wasn't extreme, but the move was enough to shake some confidence among short-term traders. But step back, and the big picture remains intact. Opendoor has been oscillating in a tight range for weeks now, between $7 and $8, with small bursts of momentum followed by cooling periods like this. In other words, consolidation. The kind of sideways trading that often happens before new catalysts emerge. The market has already digested the leadership reshuffle, the AI rollout, and the early macro signals. Now it wants fresh input, and that will come from data, not words. There's also an emotional component here. Investors and shareholders have grown hungry for updates directly from the company. Many have been watching the leadership's active presence on social media, from Nejatian's posts about cost cuts and AI tools, to small glimpses inside the company culture. But as days go by without new announcements, it's understandable that the market grows restless. That doesn't mean sentiment is collapsing, it means people are ready for something concrete again. Pompliano offered a timely reminder of conviction on Monday. In response to questions about his position, he reiterated publicly that he hasn't sold any of his Opendoor shares. That message matters. When someone with his level of visibility, who has been outspoken about Opendoor's long-term potential, stands firm through a pullback, it sends a quiet signal to retail investors who might otherwise lose patience. It's the difference between trading noise and strategic conviction. If we zoom out, the setup remains fascinating. The company has spent the past few months focusing inward, improving operational efficiency, tightening expenses, integrating AI into workflows, and strengthening the leadership bench. All of that work happens away from the spotlight. It doesn't show up in the daily share price. But it does build the foundation for what comes next. And what comes next is a sequence of catalysts that will test whether the market has been overly pessimistic or appropriately cautious. The first test comes Thursday with the housing data. The second follows next week when the Federal Reserve meets for its rate decision on the 29th. And the third, and perhaps most important, arrives on November 6th, Opendoor's earnings call, which Nejatian has dubbed the open house. That will be his first full quarterly report as CEO, and investors will finally get to hear directly how the AI integration, leadership restructuring, and cost discipline have translated into financial performance. So, when you look at Tuesday's 5.5% decline, the question isn't whether something broke, it's whether traders are trying to get ahead of these milestones. If the housing data comes in soft, the stock's dip will look like foresight. But if the data surprises to the upside again, the pullback could easily prove to be a false breakdown, a head fake before a rebound. We've seen this pattern before with Opendoor. The market tests the floor, it wobbles, and then buyers step in when the narrative turns constructive again. Technically speaking, the $7 mark that's now broken will be the level to watch. If the stock can reclaim and hold above it in the next few sessions, that would confirm the floor's strength. If it drifts lower, the next soft zone of support sits in the mid-sixes, where the stock last consolidated in late September. The key thing to remember is that these short-term levels are less about fundamentals and more about sentiment. Fundamentals haven't changed in 24 hours. Another reason not to overreact to today's drop is volume. There wasn't a flood of selling, more like a controlled handoff between impatient traders and patient investors. Many long-term holders have been waiting for opportunities like this to add, while others simply step aside until the data drops. The market is playing chess, not roulette. In the absence of company news, speculation always fills the vacuum. Some traders are questioning whether Opendoor might announce new partnerships, product expansions, or AI-driven platform updates ahead of earnings. But realistically, the company has been consistent in saving major disclosures for official channels. That discipline is healthy. It tells us management is focused on execution rather than hype, a refreshing contrast to earlier eras of market-driven storytelling. The next 48 hours will therefore be about watching tone, not headlines. If mortgage rate chatter remains positive and macro sentiment holds, this dip could stabilize quickly. But if we start to see pre-housing report anxiety build across the real estate sector, then consolidation near the mid-sixes would be perfectly normal. The important thing is that Opendoor remains on track operationally, and the long-term thesis remains intact. It's also worth keeping in mind how detached analyst price targets remain from reality. Even after Morgan Stanley's recent bump to $6, most of Wall Street still models Opendoor as if the company's transformation isn't happening. That lag between model and market is the window where opportunity exists. When those models start to catch up, usually after a couple of good quarters, the re-rating happens fast. From a storytelling perspective, Tuesday's session actually fits the larger narrative arc of this turnaround. Every comeback story needs quiet chapters, the ones where nothing seems to happen on the surface, but important shifts are taking place underneath. Investors who understand that rhythm tend to stay calm through the dips, knowing that conviction is built in the lulls, not the rallies. Pompliano's comment reinforces that idea. He's holding, not because he's ignoring risk, but because he sees a company that's been fundamentally rewired to operate in the new housing landscape. A company whose AI agents, data pipelines, and pricing algorithms are just beginning to scale. That's the kind of transformation that doesn't show up in a daily candlestick, but it's the kind that matters over years. So as we head into the middle of the week, the tone for Wednesday will hinge on whether buyers see this as value re-entry territory. If we see pre-market stabilization tomorrow morning, even modest buying volume around the high sixes, that will suggest that long-term investors are beginning to step back in. If not, the market may stay cautious until the data lands. Either way, this is the moment where patience matters most. Earnings are now less than 2 weeks away, and leadership has already proven they're not afraid to roll up their sleeves and do the work. Nejatian joining the PagerDuty alert list last week was symbolic of that mindset. It's the signal of a leader who isn't above the details, and that culture will define how Opendoor executes in the quarters ahead. Tuesday's dip, in that light, is just part of the story, a temporary lull before the next wave of news flow. The real question isn't why the stock fell today, but how it reacts once the housing data arrives. Because if that report shows even modest improvement, it could reignite interest in everything the company has been quietly building. For now, the message remains the same: conviction through quiet. Opendoor isn't falling apart, it's recalibrating under the weight of anticipation. Investors have waited months for clear signs that the housing market is thawing, and we're only days away from seeing that evidence one way or the other. So, as we wrap up Tuesday's aftermarket session, remember, the silence before data is not failure, it's focus. The real test begins Thursday, and until then, staying centered and patient may be the smartest move in the room.